Hello from a relatively wet and wintry London. Welcome to another edition of Flash. So I'd like to talk to you today about share buybacks in the US. So recently, corporate America has rather generously been given, as if it needed it, an extra boost to the S&P 500. In the first 7 days of this month, February, US firms announced a combined $105 billion worth of share repurchases, which was more than the total for January, and which was actually the strongest start to a February on record. So in one respect, I guess that you could say that the recent buyback binge tells you that managements are getting more confident about where the economy is going. And so, as we have C-suites snapping up their own shares, in the context of a strong bull market, I think it's also wise to recall that not all buybacks are made equal or are indeed constructive. By way of example, Boeing. So Boeing allocated over the 5 years leading up to 2018 and through 2018, $39 billion worth to stock repurchases. That was the equivalent to 80% of the free cash flow during that period. Now, one could argue very confidently that they may have performed much better as a company if that instead of spending that free cash flow on share or stock repurchases, that they had instead invested in their own product. And in fact, the last calendar year of positive net income was, guess what, 2018. Another good example of stock buybacks that haven't really gone according to plan is Charter Communications. So this is a telecommunications stroke media firm. From September 2016 through until December of last year, they spent $72 billion on buying their own stock. $72 billion. That's equivalent to just over 50% of the fully diluted outstanding share count at an average price of $455 a share over the 7 years. Now, Charter, since mid-October of last year, is down 36% to $288. So think about the average price of their share buyback over 7 years, $455, and the stock price is now $288 on the back of a surprise drop in internet subscribers during Q4. The company market cap is now $42 billion. So in other words, the market cap is now only 58% of what the company has spent over 7 years on share buybacks. And over that time as well, part of the way that they've done that is by increasing their net debt from just over 60 billion at the end of 2016 to 98 billion at the end of last year. So here again, a really strong example of how share buybacks don't always work. So as somebody famous in private equity once said, balance sheet leverage is like chocolate cake. A little bit hits the spot, but too much can make you sick. Having said that, let's just go through very quickly why companies undertake buybacks. So quick revision on, the theory behind companies buying back shares. So for companies with excess cash, there are essentially 4 choices that they can choose between. Number 1, undertaking CapEx, investing in other ways into the existing business, maybe something that Boeing should have actually done. Number 2, they can pay out cash dividends to shareholders. Number 3, they can acquire other companies, business units, etc. And number 4, of course, they can use their cash or debt that they raise when particularly the cost of debt is cheap. They can use that money to repurchase or buy back their shares. So just like a dividend, a stock buyback is a way to return capital to shareholders. Now, clearly, share buybacks reduce the number of shares available in the market. And so other things being equal, that increases the EPS on the smaller number of remaining shares. Now, there are good reasons for some companies to buy their shares back. So some companies will buy back their shares because they believe that their stock is undervalued and therefore it's actually a good buy at the current price. So for example, Warren Buffett uses stock buybacks when he feels that shares of Berkshire Hathaway are trading at too low a level. The directors of Berkshire have emphasized that they will only authorize repurchases at a price that they believe to be well below what they call intrinsic value. So in that respect, buybacks can of course be very much value additive, and they can also create a level of support, at least in the short term, for stock prices. And buybacks are a good use of capital as long as the company undertaking the buybacks is actually shrinking its share count and doing so out of free cash flow, as opposed to just levering up. So what is an interesting factor with respect to the stock market over the last 5 years is that when you look at the leading 125 buyback leaders, and that's when viewed as companies who have bought back the highest percentage of their shares outstanding, they average 16% annualized returns over the last 5 years, which is actually slightly better than the broader market. But there are also some real stars. So we've got some real outliers out there, like Builder's First Source, ticker BLDR, which was the standout top performer over the last 5-year period. They generated, get this, a 69% annualized return. So, on the whole, what we're saying here is that share buybacks really can create value, but as we saw in a couple of examples at the beginning, not always. And what's also interesting is that a lot of the companies who are being very effective with their buybacks and actually creating some value for the corporate is these companies are actually old economy companies. And if you look at the breakdown according to the GICS sectors and the subsectors, it's quite telling. And the leaders in the kind of buyback table are actually old economy and also particularly energy related stocks. So in conclusion, if you look at the sort of factor breakdown in terms of outperforming over the past 5 years, buybacks have actually been a really prominent factor. And those companies at the top of the sort of buyback leaderboard have actually even very slightly managed to beat out the momentum factor. So we hear a lot constantly about the Magnificent Seven and about the momentum behind things like AI stocks. But actually, if you look at buybacks as a key factor over the past 5 years, they've actually slightly outperformed momentum. So one could say that a solution to not being exposed, if you think that, for example, the Magnificent Seven have, started to top out, if that is your view, then one solution, especially if you're looking at what's known as kind of value or small caps, then what you should be looking for is companies that have significant share buyback programs, stock buyback programs, and who are using not lots of debt, but who are using their free cash flow to buy their own shares at what could be described as undervalued valuations. So that corporate buyback at the right levels and using the right sources, i.e. free cash flow, can be a really powerful source of outperformance, particularly at the sort of small cap, mid cap end of the market.